Good morning. You're watching the market right here in 80 now, and after making it to that 18,300 print in the Nifty futures in just trade yesterday, the big question is whether an all-time high or a new high for the index alone is in sight or not. By the way, after yesterday's close above that 18,260 thereabout print, we're only 3.5% away from a life high on the index. The good news, of course, continues to be that FIIs continue to pour in money, and they've been buyers for an 8th consecutive session. The Nifty has managed to gain the most it has from those March 29th lows in about a month's time. So, new high, yes or no? This week or no?
What have you done? Green is missing.
And red would have compensated, and she's wearing red. Beat that.
I think we are on course to make a new high.
Yeah.
Now, whether we'll make it in the month of May, whether we'll make it in the month of June, I think that is conjecture. But you are on course to make a new high. Frankly, if you ask me in terms of narrative, markets are moving exactly as per the script. The naysayers are now suddenly believers, and the believers are forced to jump in at higher levels. All the FNO data, the FNO data what we've analyzed clearly seems to be pointing that not only there is a change of heart, there is a change in terms of the positioning by FIs in the cash market, by FI in the FNO market, and the activity which has started in the retail market. Now, the question is pretty much the same what we put out on the screen, which is that after a 1500 point rally from 16,800 to 18,200, is the risk reward still favorable? Well, if you're a momentum watcher, I still feel that you should not cut your long positions. And why am I insisting that you should not cut your long position? Took a 1500 point rally is a smart rally, and markets may take time to digest it. But typically when markets they top out, there are some data points, and if you map the historical patterns with the current data points, I don't think we've reached what could be called as a overbought zone. See, Avan, Aisha, my sense is that there is a difference in consensus view and consensus pricing. India is the go-to market, that's a consensus view. But even though India is a go-to market, I don't think we've reached a level of consensus pricing. And typically when markets they peak out, the technical indicators have to become extremely overbought. FI positioning has to change. I don't think we are there yet. Will we make a new high in this dash? I don't know.
And FIIs have just come back to the market. It's only been 8 sessions of some, meaningful buying.
Exactly. So they have to rebalance whatever they have sold. Markets, and since we are talking the FI language here, markets they typically peak out when the FI ownership in the market goes above 20%. And that happened in 2021. I think we are not even close to 20%. So there is still a lot of headroom left for markets to go higher. So in the near term, the technicals are not looking scarily overbought. And in terms of the positioning, I think the positioning still has some more headroom left. So a new all-time high is coming. In the month of May or June, I don't know. But in summer of 2023, yes, sir.
Okay, so that is one thing that Nikunj seems to be very clear about. But we were talking about the FIIs, and it's just pretty interesting to map out, as Aisha alluded to, yes, 8 straight sessions. And if we're looking at the kind of FII data that we've witnessed over the last few months as well, yes, it is in the month of April that you did see a buying for FIIs, month of March as well. But otherwise, on a year-to-date basis, you have the FIIs that have sold close to about 37,000 odd crores. So definitely some FOMO moment for the FIIs, Nikunj, as you were alluding to. But if we were to just look at some of the other factors as well, as the Sensex is nearing that 62K mark, apart from FIIs, the fact that you've got Brent crude prices that have been fairly supportive, there's been a recovery in banking stocks as well, and the macro outlook for us is improving.
So everything is moving as per the script. What is a favorable environment for India? Commodity prices have to remain benign. Interest rates, at least in the short term, RBI is very clear that inflation has peaked out. B, liquidity has to reverse from global markets back to emerging markets. That is happening. And then you should be on a cusp of a new cycle. And I think that is evident if you really look at the way how the banks, autos, and some of the consumer companies have moved. So these are this is a good environment, both in terms of macro, in terms of positioning, and also in terms of where the participation is likely to move. I always say that in markets, don't focus on where the puck has moved, but focus on where the puck will move. And I think the puck for Indian markets has moved this year in our favor. So I go back to that same point once again. I think, yes, optically you may look back and say, okay, 1500 points, yes, it's a big gain for the Nifty. But where is the participation? Where is the excitement? Where is the euphoria? There is a lot of disbelief, a lot of FOMO, and everybody in a sense is just looking at the Nifty and individual stocks rather than participating in it. We'll talk about individual stocks where there is a bit of froth which has started, but in general the shape of the market and the texture of the market certainly does not remind me of any euphoria or any overbought conditions. I'm sticking my neck out and saying it that in summer of 2023 we'll make a new high. Whether it is May or June, I don't know, but it will happen.
Okay. Summer it is that we are awaiting. But, earnings as well have been supportive, and you've got to give credit where it's due. Because if you just look at how the Q4 earnings roundup has been so far, and the profits have managed to jump almost about 10% on a year-on-year basis for India Inc., led of course by financials. If you look at the Nifty FY23 EPS, that's largely stable. So far in the earnings season, of course, this is the fag end of the large, big numbers this week, that is. There have been no meaningful downgrades or upgrades coming in so far. So it's been pretty steady a ship in that sense. If you look at technology, that of course was an eyesore, but largely you'd have to say it was a mixed bag for technology as well. It's tier 2 companies which are performed as opposed to the benchmarks. We've already seen that the disappointment coming in from especially Infosys. When it comes to banks, it's been a very, very steady performance. They've seen further expansion in margins in Q4. Automobiles, mixed but encouraging when it comes to the fourth quarter, except of course Maruti, which was an outlier. Consumption, green shoots in rural demand, although Dabur was an outlier, but then again, that was a standalone case. Oil and gas, Reliance again has outperformed. It's managed stellar O2C business, reportage when it came to its Q4 numbers. So that again is a good thing, right? Because there's been no alarming bad news. Technology, yes, but that's something you already knew about.
Technology stocks are down on an average 25 to 40% from the 52-week high. So technology is no longer this go-to space. And if you frankly look at most of the funds are either market weight or overweight. In general, I guess the surprise has come from the fact that most of the companies which had felt the heat or the pinch or the impact of high commodity prices and low demand, they're reversing their outlook. You see, you'll always have company-specific issues, like Aisha rightly pointed out, let's say in case of Dabur. But Marico, completely different kettle of fish. Nestle, optimistic. Britannia, super numbers. Tata Consumer, decent. So you'll always have pockets where markets will feel the heat. So for example, consumer durable. It's not been a great quarter for consumer durable. But consumer durable will always come up with a lag effect. When there is high inflation, the first impact will always be felt by consumer discretionary and consumer staple. Then it will go to consumer for white goods and consumer discretionary. But when the reversal starts, first comeback will always be done by consumer staples, soaps and shampoo. And then when you start getting more savings back into the system, you will start spending more. Yeah. So I think we are 3-6 months away from the real recovery in consumer durables. Hopefully the Diwali numbers and the Dussehra numbers would be very different. So it's a good time to buy some of those stocks now.
Okay, that's the view coming in on the individual stock action, but there's a lot of murmur and buzz as well when it comes to events that we'll be watching out for. And in the primary markets now, you've got Mankind Pharma as well. That is going to be the cynosure of all eyes, as the IPO listing date is going to be today. It's going to be hitting the stock market, and do remember, we've got the share price available at a premium of about 120 per equity share in the grey market, so we'll be watching out for a 10 to 12% is what the street is working with. And there's Nexus Select Trust as well, and that one's got its IPO opening for subscription. Amidst all of that as well, it's a hectic day on the earnings calendar. The likes of Lupin, Raymond, Westlife, Apollo, as well as Nazara will be coming out with their quarterly numbers. So Nikunj, it certainly is a fairly busy day.
If you frankly ask me in terms of the number scorecard or the number results calendar, nothing big. You got Raymond's, which would be interesting considering that there is
Even
a deal.
Westlife, given the way the stock has been
Yeah,
performing.
Westlife would be interesting. I mean, I went for a shoot over the weekend to Gujarat, and I was absolutely amazed to see that in the Mumbai Gujarat highway, and we take a road trip this time. The amount of McDonald's which are coming up, how that entire development, how Starbucks is coming up, how Burger King is coming up. So I think they're expanding, and they're really expanding beyond metros now. I think a lot of places in India, burger is now replacing vada pav. I think that phenomenon, is apparently evident. I don't track Westlife that closely, so I don't have an understanding of the numbers. I'll have to do some homework there, I must confess. But Raymond's, I think, would be the big one from a market curiosity standpoint, largely because the deal's been done. And markets would like to know that what are you planning to do with the cash? It's an been performing stock. Why are you looking at raising money via the NCD route? And are you looking at making Raymond's debt free? So those numbers would be important considering that it's a warm stock, and the stock in a sense has it captured a lot of headline when they sold their business to Godrej Consumer. That's one. Second, if you ask me, Mankind Pharma is the interesting one today because they get a very large, sizable domestic business. It's a large pharma company which is going public. The grey market premium is not very enviable. We can argue back and say that valuations are slightly stretched if you compare it with the traditional pharma companies. But I think this is a unique company. It's got a unique positioning in terms of the margin. It's a big IPO which is coming after a while now. And pharma, in a sense, has generally seen a change of heart in last couple of days. So Mankind Pharma, I think, could be an exciting one to watch out because this is a different company with a large domestic focus, and I think that really would be the differentiated factor here for it.
Okay, let's move on. Let's bring on board Kunal as well as Naresh and find out what they're reading on the charts. Kunal, hi, morning. Made it to 18,300 yesterday. Guess an all-time high just shy away.
Yeah, some distance away. So some days, maybe a couple of weeks for the markets to climb up. But then, the recovery for the markets after Friday's thrashing the indices got, where the Nifty was down, I think, some 180, 200 points. The Bank Nifty was down almost 1,000 points. So to recover it on the subsequent day was quite a stellar, comeback for the indices. And again, it was not, too much dependent on the large cap names, which were actually getting beaten down on Friday. So there were new set of large cap names which made a comeback, the FMCG stocks, auto names. Bajaj Auto made a very strong comeback for itself. Banking names, ICICI Bank made a good comeback above the 940 plus mark. So there were a lot of different large cap names which managed to lead the markets and balance the markets after Friday's selling pressure. That was one of the standout features of the markets yesterday. Again, slight built up in the open interest for the Nifty as well as Bank Nifty, some 6% jump in the OI on the Nifty as well as some 2.5% jump in the OI on the Bank Nifty. That also indicates that traders are more inclined towards holding on to long positions as well as creating more longs on such kind of days. So all in all, positive for the index, 18,450 on the spot levels could be the next set of targets.
Naresh, should one now approach the market with one eye on a new high? I mean, do you think that really should be the trading strategy rather than looking at today, tomorrow, this week, next week? One should now align the portfolio that there is a strong, not probability, but a possibility that in summer of 2023, this market will make a new high. Should that be the basic trading approach?
So the view should be the trend could continue to surprise us on the upside. So whether it goes to a new high, much higher than the new high. So overall, what we've seen is when we start reversing from such bottoms, the trend continues to surprise. So like we thought there should be a pause at 17,400, then at 17,800, then 18,200. And now we'll see a pause at possibly 18,600, 800. But every step we've been seeing good contribution. What is interesting is the top two heavyweights in the Nifty have still not participated, and we are talking about a new high. So if you look at HDFC Twins as well as Reliance Industries, that they constitute 25% of the index. And we've still not seen a new high in HDFC Bank for 2 years. We've not seen a new high on Reliance for the last 2.5 years. So what happens if any one of these overweight fires up? The all-time highs are say 500, 600 points away from here. That's not a huge move. It's a 4% move from here on. Not a big move to actually be excited about, but technically the trend is strong. You continue to ride the trend, and the best way you can ride it is be bullish till the time there is a change in trend. And as of now, there are no reasons to be not bullish.
I want to go back to that point that yes, it's a 1500 point rally for the Nifty, but just because it's a 1500 point rally on the Nifty, that does not mean markets have topped out. There are data points which, in a sense, are giving me confidence to really endorse the fact that market uptrend is not over. What are the basic trends you look at? Total open interest, which is not very bulked up. Second, FI positioning in the F&O market. 1 month ago, they were net sellers. Now, even though they've become net buyers, that positioning is not scaringly one-sided. Third, if I look at Nifty futures, the premium is not very fat, which means the level of participation is low. So these are typical factors which, in a sense, and there's no mathematics here, but these are typical factors which I've always analyzed historically to understand which way the market in the short term is moving. And Kunal, yes, 1500 points. Oh my God, 1500 points to bahut hota hai. But that does not mean market will top out. Do you agree with the pointers which I just mentioned?
Yeah, I agree. In fact, I was actually looking to add one more point. The VIX, the India VIX is nowhere close to 10 and below 10. So I think on last week, one of the reasons for market correction was actually when the VIX had come back towards that 10.5 levels. This was 4 times in the last, I think, 5-7 years. Whenever the VIX has come back to that kind of a zone, it sort of leads into mild correction for the indices. But what happened on Friday and yesterday was quite intriguing. After a drop on India VIX at the 10.5 odd levels, the Nifty managed to correct, and now on yesterday when the markets were actually back up at 200 points on the Nifty, the India VIX is still at 12.5 levels. So which means there's room for the markets to move up higher till the time the India VIX comes back again to that 10.5 zone. So with the fact that the VIX is nowhere close to that all-time lows, that also is an indication that the markets have room on the upside to move up higher.
Okay, let's nail it down to those individual stock ideas now that we've gotten a sense as to what the factors are at play for the index's next move. And Naresh, let's find out, what are you picking out?
So the first stock would be a buy on Axis Bank. The stock has made a starting move above that 870, 880 mark, attempting for the last few sessions. Technically, the whole longer term retest is done. It's still the stock returns is not great from the time of 2019. The stock used to be 800. That breakout happened. We went up to 970, did a retest of 820 in the recent fall. And now we are setting up for the next leg of the move, which is where I would expect it to take leadership, go all the way to a new all-time high over the short to medium term. Out here, the risk reward is still great. The last 2 weeks highs are around that 880 to 890 mark. Expecting it to break out above those levels, keeping a stop loss at 860, an initial target price of 930, a longer term target would be way higher. The second one is a buy on Ambuja Cements. The stock went through this big fall in the Adani issue. The stock fell from 530 all the way down to 320, 330 levels. For the last 4 months, it has made a triangle consolidation. All the tops are around 400, 405. This is the 5th attempt. Finally, we've crossed above those levels in the last 2 sessions. Breakout above this gives a quick target price of 440. Stop loss to be kept at 390.
All right, there you have it. That's what Naresh is picking out for the day. Meantime, Kunal, let's get in those stock-specific strategies.
So 2 buy calls. The first one is a buy on Info Edge. The stock making a inverted head and shoulder pattern breakout yesterday on the back of some extremely strong volumes. So would suggest a buy 4,300 as a positional target, and stop loss could be kept at 3,800, 3,840 levels. And the second would be one Anantraj Industries, real estate stocks making a very strong comeback, of course led by DLF, Oberoi Realty, etc. But Anantraj also looks very attractive. So would suggest a buy, targets of 150, stop loss 136.
Okay, those are stocks in focus this morning. Let's also then hear it out from Rajiv Thakkar from Parag Parikh Mutual Fund. He believes that banks are right now sitting on a clean balance sheet and it is very attractive a business if they run it well.
So right now in India, we are in a period where banks have cleaned up their balance sheets. All the earlier corporate credit losses were cleaned up. Then COVID provisions and people have come out of COVID quite well. So today they are sitting on clean balance sheets. The market share shift from PSUs to private sector continues. Given that interest rates are higher, the CASA rates are, CASA benefit is coming in where these spreads can be higher. And we don't have the problems like excessive lending to commercial real estate or problems in terms of huge amount of bond losses and things like that. So I think in India, banks are quite well placed. I would think that they are trading at multi-year low valuation multiples. That is a space that we are quite excited about.
That's the market view coming in from Rajiv Thakkar. But meantime, it's clearly looking like very unusual weather across different parts of the country, as there's been snowfall that's hit towns in Jammu and Kashmir and Himachal Pradesh. In fact, the average temperature have been among the lowest since the year 1951. Although the snowfall in May is not entirely uncommon, the higher reaches of the Himalayan region, it is unusual to have snowfall in some of the low altitudes. So the visuals on your screen are of Spiti Valley, which is completely snow-clad. There's a small town of Gandarbal in Kashmir as well that's seeing a thick blanket of snow.
Well, talk about unusual weather patterns, and heavy rains have led to floods in parts of Bangalore. In fact, RV Road in front of Vijaya College in Bangalore has been waterlogged after heavy rain last evening. Visuals from yesterday, as you can see on your screens, are showing two-wheelers and three-wheelers wading through a heavily flooded road.
All right, time for a very quick break right here on the show. Be right back as we'll bring on board our experts for a lot of market talk.
Back with the market right here on 18 now, the SGX Nifty indicating a quiet start, but you know what? The past many trading sessions, we've had exactly the same print on the SGX, and then of course the market does what it does, managing to close at the session highs. Just fingers crossed, hope today is another such day. But we've been in good stead. We've seen consecutive FII buying for the last 8 sessions, in fact, and the quantum only has been increasing. You've got a print of 18,300 now in the Nifty futures as of close yesterday. But let's talk stocks which could propel the markets higher, and the Aditya Birla Group firm has entered into a definitive agreement to acquire a 51% stake in TCNS Clothing. Remember, these were 2 stocks which tanked heavily in trade yesterday. Now, TCNS owns ethnic brands such as W, Aurelia, Wishful, Folk Song, as well as 11. Vamakshi is here to tell us all about the conference call details which took place just last evening.
Well, yes, in the con call yesterday, ABFRL highlighted that with the TCNS acquisition, the ethnics portfolio is now complete and they will now be focusing on building the existing portfolio of brands. As far as the rationale behind this whole transaction is concerned, they highlighted that the vision earlier was to build a brand organically, but they did come across this opportunity and realized that building a brand of this scale would take them more than 10 years at least. So therefore, ABFRL thought that it would be a better option to adopt the inorganic route. Now, as far as the vision ahead is concerned, 5,000 crores of top line is what they're expecting from the ethnics portfolio by FY27, and more than 50% of it would come from the TCNS brands that they've acquired. Now, W and Aurelia, which happen to be TCNS brands, are expected to become rupees 1,500 crores brand each. Tasva is seen as a 1,000 crore brand, while Sabyasachi, Tarun Tahilyani and others are expected to come together to generate almost 1,000 crores of revenue. Now, as far as the debt is concerned, the acquisition of 1,650 crores is expected to be funded with a debt of almost around 700 to 800 crores, and with that, the net debt to EBITDA ratio is expected to increase to 3 times. But the management is quite confident of bringing this ratio below to 2 times in the long run. They are also confident of achieving double-digit EBITDA margin in TCNS plans within a short period of time, and they are also, based on the current judgment, TCNS is expected to start being EPS accretive from FY25 or FY26 onwards. So largely, those were all the important takeaways that have come in from the con call.
The above transactions will be one of the largest deals in the Indian fashion space. Way back in 2018, we had explicitly stated our growth strategy for the coming years to be built around ethnic wear, the largest segment in the Indian fashion space. Over these years, the company has made several organic and inorganic moves with an objective to build comprehensive portfolio of brands in this key segment. This deal will allow us to expand our existing ethnic wear portfolio into the largest sub-segment which is premium women's ethnic wear segment, where the branded part of the segment is expected to grow at high double digit for years to come. This acquisition will be funded by incremental debt and internal accruals.
All right, let's move on to more stocks in news. And after the recent MSCI changes, 4 more names could be included in the index, according to Morgan Stanley, besides the revision in weightage that we'll see across stocks. Let's take it across to Somit to understand how this is going to affect the flows in respective stocks. Somit?
Well, the MSCI announcement is expected to come in on May 11th, which means that the stocks would react on May 12th on the potential announcement of inclusion or weightage increase. Now, Morgan Stanley believes that there are 4 stocks that could be probably included in the MSCI index, and they are expecting revision in weightages of 5 stocks. They are expecting overall inflows of close to $1.3 billion US, out of which nearly $745 million US could be towards only one stock, and that is Kotak Mahindra Bank. However, the stocks that are in the list of probable inclusion in the MSCI index, the names are Hindustan Aeronautics and Max Healthcare. Now, both these stocks have a high probability of getting included in the MSCI index. Now, the Morgan Stanley is expecting inflows of close to $175 million US in case of Hindustan Aeronautics, which is nearly 5.6 times its 20-day average volume, and in case of Max Healthcare, they're expecting inflows of close to $256 million US, which is nearly 14 times its 20-day average volume. There is a possibility of Cummins India and Ashok Leyland also getting included, but the chances are on the lower side at this moment. And if the stocks get included, then the inflows could be in the range of around 140 to 150 million US. Now, on weightage increase, Kotak Mahindra Bank, Interglobe Aviation and Samvardhana Motherson have the chances of getting increase in their weightage, which could lead to inflows of close to 18 to 28 million in case of Samvardhana Motherson and Indigo, while $745 million US in case of Kotak Mahindra Bank. And lastly, Adani Transmission and Adani Total Gas, both these stocks would see a reduction in their weightage, as MSCI had indicated few days back, and Morgan Stanley is expecting an outflow in the range of around 80 to 120 million US dollars for Adani Total Gas and Adani Transmission, which is nearly 9 to 10 times that 20-day average volume. So keep an eye out for all these stocks in trade.
All right, we certainly will keep an eye out on all those stocks in today's trading session. Moving right on then, MGL reported a beat in terms of their quarterly numbers. Profits jumped over 50% and EBITDA per volume has seen the second best quarter. Let's find out a little bit more in terms of their quarterly performance, Samit.
Well, Mahanagar Gas reported a strong set of numbers. If you see, compared to consensus estimate, their EBITDA was 18% ahead, while their net profit was 20% ahead compared to what the street was expecting. Unit EBITDA, if you see, that has come in 57% higher on a Q-on-Q basis, and this is the second highest ever unit EBITDA reported by the company in the fourth quarter of FY23. However, the only disappointment coming in from Mahanagar Gas was the flat volumes on a sequential basis. However, on a YY basis, the volumes did manage to increase around 5 to 6 odd percent. Now, why the numbers were strong? Because the gas prices were lower for the company in the fourth quarter on a sequential basis. It dropped by around 13 odd percent, and this is because of better non-APM gas procurement, because APM gas, as the domestic gas prices were pretty much stable on a sequential basis. Also, the company announced a dividend of 16 rupees per share, which is nearly 2% dividend yield. Now, the key thing to watch out for from Mahanagar Gas conference call today at 4 p.m. would be the commentary on volumes. If the company is confident enough to sustain volume growth on a 5 to 6% basis, then the stock this would be positive for the stock going ahead. Now, IGL would also be reporting their numbers today, and keep an eye out for that stock also, given the fact that Mahanagar Gas has reported a strong beat. IGL could also report a good set of numbers in the fourth quarter of FY23.
Right, Samit, we'll leave it at that. That's the factors impacting MGL. But Sun Pharma, that's going to be another stock which is going to be in focus. Morgan Stanley has come out with a recent note on this company. Let me take it across to Vinny and find out what does it entail.
In the note, mainly this specifically it's highlighting on the Revlimid, which has been launched by the company in April 2023. What Morgan Stanley is highlighting that this would actually help Sun Pharma in terms of offsetting its near-term earnings headwinds, and for the medium term, they see this being a few growth drivers as well, including the Foreto as well as some of the other drugs, which could be a growth driver for the company. Sun Pharma has actually grossed a 2.35% volume market share for the week ended April 28th. So That is an important update coming in there as well in the note. And obviously the brand which is launched is net sales pre-generics were around $8 billion. So there's a huge market opportunity also that comes in for Sun Pharma. That is why Morgan Stanley is overweight on Sun Pharma, given a target price of 1,170 rupees per share, assuming that 40 to 45% of the price erosion, low single-digit market share. They expect Sun to gross around an 80 to 120 million in terms of the annualized sales from here, with high margins as well. That is why they believe that this could actually offset any headwind in the near term that we could see coming in for Sun Pharma in terms of the earnings. And for the medium term also, this could turn out to be a few of the growth drivers with some of the other generic drugs.
All right, thanks very much for giving us those details. Moving on then, there's Aarti Industries as well. It's going to be on focus on the back of their weak fourth quarter revenues, and margins as well on a sequential basis were lower. Let's find out a little bit more about the quarterly performance. Sharad is here with all the details. Sharad?
Well, yes, in focus we are having Aarti Industries, and it came out with its quarterly numbers for the fourth quarter, and the numbers were below street estimates, and this underperformance we are seeing in the stock for the second straight quarter. Now looking at the numbers, revenue is also down almost 1%, and the EBITDA numbers, that was down almost 13%. If you look at the total numbers overall, we see that the revenue growth issue is still remaining. However, if you look at the gross margins part, that has actually increased sequentially because of the raw material cost cooling, especially for toluene and benzene. But however, there are certain issues which still pertain with the company, and of course the inventory loss, that remains an issue. And overall, if you see, the elevated costs as well as a weaker product mix actually impacted the overall numbers for the fourth quarter. But now going ahead, what are the triggers for the company? And in focus we'll have that is expected that it will sustain its volume growth going ahead, and this is coming because of the multi-year supply contracts which the company has. Apart from this, the elevated cost and the global economic slowdown is expected to be visible as the short-term, near-term challenges going ahead, and the brokerages have also stated that the ROEs might be impacted and they may fall below the 12 to 13% band.
Okay, a lot of talk around Paytm as well as Zomato, especially after the commentary that you heard from Paytm post their earnings, wherein the loss is narrowed, and now they're talking about an increased path to profitability. Here's in fact Dipan Mehta telling us what he thinks of whether you should be investing in these stocks or not.
Yeah, I think ever since listing of Paytm, that's been the biggest bugbear with investors, that when is the company going to turn profitable? And now I think that particular event is very well in sight. Very impressed with the way they have curtailed the expenses. The value proposition of Paytm remains strong as ever, and some of the innovation which they have done, like the sound box, is really, I think, quite impressive, and that helps them grow the merchant network. And then it's a platform. More and more people there are on the platform, then they will look at other services and products offered by Paytm. And I think the strategy is clearly playing out, because if you see the kind of earnings which are coming in from organizing loans or from some of the other financial products, is steadily growing, and that is covering a lot of the losses on the basic payment business. So I think the entire company, its strategy, its core business performance is all playing out pretty well. For the time being, I think Zomato and Swiggy are going from strength to strength. It's a fabulous duopoly, and they are changing habits as far as consumption is concerned.
Okay, let me welcome on board Deven Choksi and find out what he's making of the market temperament right now. Deven, hi, good morning. Great to have you in the show. Deven, at the fag end of the earnings, tell me what stood out for you, because while technology has been mixed, banks have been steady, automobiles mixed, Maruti clearly the eyesore there, FMCG again, one would say flat, but Dabur really stuck out like a sore thumb, and oil and gas, Reliance clearly outperformed.
Good morning, Aisha. Well, I think clearly the winner of the pack remains the banking segment. And in banking segment, we are basically experiencing the corporate lending as well as the retail lending books growing for most of the banks. With a 20% kind of a growth in the loan book, I think they remain pretty solidly placed as far as I think the outlook going forward is concerned. Also important point that in the rising interest rate scenario, many of these corporate banks been able to maintain their CASA ratio well, as a result of which the liability side remains, I think, pretty comfortable with the higher proposition of NIM continuing for them. So all in all put together, lower amount of, I think, the NPAs, better management of the liability side in form of collection of deposits, and higher amount of growth continuing from the loan book side. I think so bank remains clear winner, clear performer, outperformer, as you want to call it. Second important area where I find that I think things are relatively good are the companies which are consuming commodities. The commodities consumption, both in food category as well as in industrial category, the cost has come down, and as a result of which most of the FMCG companies, including Britannia, have shown remarkably good performance. And at the same time, this performance is coming from the tier 2, tier 3 cities. That means they are of first 30 cities and they are going into the rural markets. That is very, very important for higher consumption and sustaining of the higher consumption. At the same time, in the industrial commodity segment, auto ancillaries particularly looks relatively more favorable at this point of time, because the basic commodity prices, the metal prices have remained subdued, and I think likely to remain subdued going forward. Should that situation continue, then auto ancillaries would look relatively better performance stocks. Also because of the fact in auto, the demand scenario continues to remain buoyant. So these are the two main key takeaways as I see it, I think, from the entire result season. One on the consumption side in FMCG and auto ancillaries and autos. And on the other side, I believe, I think the banking stocks, they remain clearly winners in this entire result announcement up till now.
All right, that's Deven's assessment of the earnings season. But let's shift gears then. Which are the stocks on the editor's radar? Interesting names that we've picked out today. Mankind Pharma, the cynosure of all eyes today. And it is a well-established company as well. We are all looking forward to the listing, and all experts are saying that it is going to be at a healthy premium this time around, given the kind of grey market action. Macquarie as well said that it's well positioned to double its profit by FY26.
You're going to introduce the company and say, okay, a pharma company, but it's a pharma company which gets more than 97% of its revenue from the domestic market. So it's a pharma company which gets almost its entire cash flow from the Indian market. Now that's the differentiating factor. Why is that a differentiating factor? Because if you look at any of the other Indian pharma companies, whether it is Sun Pharma, even a domestic focused company like Cipla, they don't get more than 40% of their total business actually from the domestic market. That data point will just come up on your screen. That's part one of the story. Part two of the story, if you're a domestic focused pharma company, there you go, that's the number which tells you that Mankind gets 97 and Cipla and Lupin don't even get 50. Torrent, which is a slightly higher in terms of market share, but 50% is still non-India. This, I think, is a differentiating factor. This means that there will be visibility in the numbers and cyclicality would not be there. Unlike the US generic market, in India, the drug price trends are not always very volatile. Second, the return ratios, I think, are very decent, whether you look at return on equity or cash flow generation. That means it will command a strong P multiple, which will be certainly higher than a Sun Pharma and a Lupin, which means it will be trading at the higher end of the P multiple. So then what is the comparison? I don't think it will command as a P multiple which is as strong as MNC pharma companies, but it would be a discount to that. So you bake in that discount and you say, where can the stock open? I think a 10 to 15% appreciation and maybe some follow-up buying for Mankind Pharma after that cannot be ruled out. Which is the growth market in the world? It is India. Why is it growing? Because Indians are addressing their needs because per capita is going higher. So we are buying branded apparel, branded watches. We're spending more in terms of healthcare, and they have a strong presence in the chronic care, which is where I think the advantage for Mankind Pharma would be. So I'm not using superlatives to describe Mankind Pharma, but I genuinely feel that this really could be the listing of the season.
Listing of the season, okay, that's Nikunj's word. Return ratios looking favorable, as well as the P ratio, all of that working well, and of course the domestic business. Let's move right on then. It's interesting because we've been talking about the food delivery space and of course the two dominant players, Zomato as well as Swiggy. And it's interesting in terms of the kind of market share that they hold and the fact that they, in terms of their peak valuation as well, they've come off.
Okay, you must just remember that there is a very big difference in Swiggy and Zomato. Of course, they both deliver food, so that's not the difference. The difference is Swiggy is not listed and Zomato is listed. Since Zomato is listed, it is an auction market where prices changes on a daily basis. From the peak valuation, Zomato has come down from about $15 billion to the current valuation of about $6 billion. For Swiggy, what Zomato, because it's listed, the price discovery happens on a daily basis. For Swiggy, it is happening only when the existing investors or an external valuer, they come out and change the entire underlying valuation. So what Zomato has experienced 6 months ago, Swiggy now seems to be experiencing now. That's a very big difference. Yeah. So for those who are thinking that, oh, Swiggy's valuation has come down and it's going to have impact on Zomato, no. Second, it is also important for us to understand that since this is the buzzword right now, ONDC and I'm getting my burger and pizza at the 50% discount, these are very early days. While I'm not undermining the impact of ONDC, it's a great idea and it is a platform which will have a great impact in terms of how e-commerce in India would be done. But for me to imagine that right now they would be in challenger, but to imagine that they could be changing the food delivery business in a disruptive manner, it's too early. I mean, imagine a restaurant, you can only focus on micro deliveries. Yeah. You will have to invest in personnel. You will have to buy two-wheelers. You will have to get into more HR ka management jhanjat. Do you really want to invest in that? Yeah. I think it would be a bit of a struggle. So I think that is an evolving process and it could take a couple of years before we realize that how the food delivery dynamics would change. So to cut a long story short, Swiggy impact, zero. ONDC, I think is work in progress.
Yeah, so it's too early to tell. So that's interesting, Aisha, as we flagged off these two stocks on the editor's radar.
Oh yeah, absolutely. Deven, in fact, wanted to get your thoughts in as well on Mankind Pharma, whether the IPO was a subscribe and for those who did not get the allocation, what next?
I think at the IPO price, the stock was valued at around 30 times the price earning ratio. And should the company continue to grow at a pace at which it has demonstrated in past, then this listing of the IPO under offer for sale could possibly result into sustained price earning ratio going forward as well. Now that is going to be somewhat a challenge as I see it. I think largely because of the fact that I think the growth sustainability is something which we are not absolutely very clear about. Plus, okay, I think the price performance point of view, one wants to talk, then probably I think it will remain steady from here on because largely that hangover of offer for sale has gone now. And as a result of which, I think the price performance remains steady. But the growth in earning is something which I think we'll have to experience going forward as well. Otherwise, I think the other fundamental story as far as the company is concerned, they remain intact with the valuation remaining relatively on an elevated side. So unless I think you get price discount in the market, probably the margin of safety, as we call it, as I think, is not available in this particular stock.
Right. Okay, that's the take coming in on Mankind Pharma. We're awaiting that listing. Let's talk about a couple of buzzers in trade yesterday. There was, of course, Marico, which shot up about almost 8%. Manappuram made a decent comeback, as did IndusInd Bank. Deven, do you think now with the IndusInd Bank clarification on the management rejig, all the dust settles down? Yesterday, the stock as well recovered all of Friday's losses.
I guess so, because I think on the fundamental side of the business focus remains, I think, pretty strong in the areas of the lending, commercial vehicle lending, which is there, I think, relatively, I think, a stronger play, and also some other industries, I think, in which they are focusing systematically. So from a perspective of, I think, bank looking at a higher amount of growth going forward, I think remains very high. in previous years and quarters, I think the larger amount of issue was also with the balance sheet adjustment, particularly the NPAs. I guess I think that part is also over. So I would think that given the kind of strategy in place, given the kind of market growth and opportunity in place, I would think that IndusInd Bank could possibly remain a steady to better performer than its previous past.
Well, the CTO resigns, the stock falls, and then it recovers. But I think it will have. IndusInd Bank has lost their mojo after the IL&FS crisis. They were commanding at a 3 to 3.5 time price to book, just little bit below HDFC Bank at some point in time. But that halo effect which it had of superior growth and great, great growth cycle, I think that is really behind us. In fact, it has underperformed. It has underperformed. I mean, this is one of those stocks which has not participated, Kunal, in this banking rally, frankly.
Yeah, and strange because from the September 2022 lows, IndusInd Bank was rather July 2022 lows. IndusInd Bank was at 750, and in the second half till I think the month of December 2022, the stock at one point was almost at 1250 levels. So when you look at the price recovery, when you look at the recovery in terms of where the stock was in a matter of 4 or 5 months, it was a very stellar recovery for IndusInd Bank. So all it had to do is after that 4 months of correction for the markets, the stock had to just made a comeback again and cross that 1250 mark. But it's been unable to do that even in the last 1 month of price recovery for most of the private sector banking names. So there is some concern for the stock and it's getting reflected into the stock prices. My sense is that the volume patterns are still not as strong for IndusInd Bank as it was in the second half of 2022. That is why the stock is taking a lot more time. Maybe over the next couple of months, we may expect some sort of a breakout to happen, but then I think it's better to wait and watch for the breakout rather than anticipating the breakout for IndusInd Bank.
Devin Choksi, what do you make of this news in Swiggy? The P investors have brought the valuation down. Do you see that impacting the underlying stock price of Zomato?
I don't know, Nikunj, I think whether it will immediately impact the underlying stock price, because it's not about only the cost factor at which you are delivering the food items. It's also about, I think, the convenience, and it's also about the efficiency under which it is being delivered. So yes, I think there is going to be a pressure on the margin, definitely, for sure, because out there when the competitive prices are lower, there is going to be pressure on margin. But as far as the demand scenario is concerned, I would think that I think both Zomato and Swiggy would continue to experience the higher amount of order intake, largely also because of the fact that the customers are used to the kind of services that they have been offering, and those habits don't change normally so easily. So from that point of view, I would rather like to believe that I think the journey would continue, except the fact which I mentioned, the margin pressure would be probably something which is reality in the near term. So let's see how exactly I think this particular model pans out. Whether the network of ONDC would continue to sustain offer or continue to offer the discount on a sustainable basis, not too sure on that particular aspect. And should that be the situation, that if they find out the effort to give higher discount, then possibly I think one will see the recovery back into the perception and the valuations thereafter into this particular segment. But we'll have to wait and see. In the near term, definitely I think the situation is slightly going against, I think, these both companies as far as the margin perspective is concerned.
Right. Naresh, help us with the charts of both Paytm as well as Zomato. Paytm, of course, on the back of that, commentary after its earnings and the earnings, the fact that the loss has now narrowed in the Q4 numbers, and that zoomed up yesterday.
So, like I've been saying, the view is there are 3 names in the new age companies which have made classical bottoming out formations. One is Paytm, one is Zomato, and the other one is PB Fintech. Now, Paytm is now setting up for the next leg of the move, where it gets into a momentum move going forward, ideally. So if you look at the technical structure, it made the lows around 500 levels in November of this year, made a low around 520s back in March, April of last year. Recently, we did see a move from 550 to 750 back in February. Again, saw a retest of 550 levels. And now we've come back to that 750 mark yesterday. Now, that's a start closer to 730, 740 mark. Now, that's a start. If we sustain about 740, it starts up the next leg of the move, which gives us a target price of 840, 850 levels, which was done in the last August. So technically, the shaping up is very clear. gone through a minimum of 8 to 12 months of consolidation, which is ideally needed in stocks which fall this 50%, 60%. And then you start a new trend. So positive on Paytm would have a short-term target price of 840. But overall, structurally, the trend is changing. Same is the case with Zomato. The stock fell from 160 levels all the way down to in the 50 to 40 band. Tested those levels for the last 8 to 12 months 3 times. Then over the last 2-3 months, made a consolidation between 50, 56 levels, made a breakout over there. Now we are taking a little bit of a consolidation here at 60, 66. So the highs for the last 1 year in this consolidation period is 75. So that is the target I have, closer to 75, 80 in the short term. And then if that breaks, we get into the much bigger trend. But overall, positive on these three names, which look interesting. PB Fintech similarly made that breakout and continued. So out here, I would be bullish on Paytm as well as Zomato at current prices.
The peak to getting smashed and from there a V-shaped recovery. That's the definition of how new age tech has actually moved in last 18 months. But in this episode, in our series CEO at Work, we this time visited the manufacturing facility of India's largest solar panel maker, Vare Energy. They are the 7th largest solar panel exporter in the world, and this in a sense is a clear indication of how the true blue renaissance in the Indian manufacturing sector has arrived. From an unknown brand to an unforgettable company to a journey which started 15 years ago is now picking up steam. So let's just show and let's just bring our viewers up to speed with the excerpt of our interaction with the chairman of Vare Energy.
Today, it gives me great pleasure to talk about the Vare Group, a group which is championing the entire energy transition in the world.
India has been a forefront in manufacturing for many years. Now with the government policies and the demand across the globe for the alternative supply chains, I think this is a very good opportunity that we as a whole country, we can become another manufacturing hub for the world. And Vare was always in a forefront for last 30 years in manufacturing. Of course, solar we started a little bit late, but whatever we were in manufacturing, we took the leadership at the global level.
All that mega exclusive coming on ET Now tomorrow entire day. All that mega exclusive coming on ET Now tomorrow entire day. I'm going to switch gears and go back to the comeback in some of the pharma names. And Naresh, Mankind listing is today, but before that we've seen a sizable comeback in a Cipla, in Aurobindo, in a Lupin. Do you think this is dead cat bounce or a change of trend?
So out here, what is very clear is the two sectors which did well with the whole COVID was IT and pharma. They've gone through that up cycle, then they've gone through this down cycle, and now every stock is making different moves in the segment. So if you were to look at the way Dr. Reddy's has been moving up, that's a fresh new trend, which is where the stock is not very far away from the previous highs, the all-time highs, relative to rest of the names. So the stock is 10% away from an all-time high. But a lot of these names, something like a Lupin is still down 60-70% from the highs in 2015. So you have different trends altogether. Aurobindo Pharma, even after the current move of almost 50%, is still below the prices it was in 2019 and 2022. So overall, the view is one has to take a stock-specific call rather than the whole sector. There could still be names which could continue on the lower end and not recover. So the view is we are setting up for some of the names which are showing a strong bounce back. So there's a Biocon, there's a Glenmark Pharma. A lot of these names were disregarded in the whole move of 2021-22. So that's interesting. Dr. Reddy's remains the stronger one in the large cap. Sun Pharma, although has been relatively stronger, momentum continues to lack here. So out here, I would be waiting for a tick above 1030. And that is where I would be interested in Sun Pharma the most. So for now, it's a bet on stocks like Biocon, Glenmark Pharma, which have done terrible over the last few years. And then the other bet is to go with the names like Dr. Reddy's and Sun Pharma, which have done relatively better after being in a downtrend from 2015.
Okay, getting a sense then from you, Kunal, on the charts. Some stocks that saw a breakdown in yesterday's trade. Aditya Birla Fashion, for instance, on the charts. And what about a Bank of India? Of course, it was a slew of PSU banks, but Bank of India in particular?
So, in fact, most of the PSU banking stocks, as you
Yeah.
rightly said, they were under selling pressure, but I don't see any major structural change for Bank of India. I think the stock went through a correction, 2 days of correction for Bank of India. I think from 87 or 88, the stock had made a high in the previous week on Friday. The stock made a low of 81. So again, it's a correction of 5-6 rupees for the stock price, 7-8% approximately, but nothing structural, changes in terms of the chart patterns. The stock is still showing signs of good volumes built up over the last 4-5 days prior to the correction, and then I think at current levels of 80-81, it's actually come back towards a good attractive zone to go for a contra buy. And for ABFRL, I think what actually transpired is the last 7-8 months back, when the stock was almost at 350-360 levels. It was looking extremely strong, in terms of a breakout, but then followed 5 successive months of price correction for ABFRL. So after this kind of clarification in terms of news flow, the last 5 months or the correction of that 5 straight months indicates that the stock was building up to that kind of a news flow for itself. Now that the news is out, I believe major part of the volatility could be out of the stock over the near to medium term. So traders who have been wanting to buy ABFRL because of the last 7-8 months of price correction downtrend for the stock, I think at current levels, because the news is out, the event is out of play for the stock price, it's a very good and attractive play from a medium to long term play. So I think at around 200-205 levels, ABFRL could be a very attractive risk reward buy from a medium term play.
Okay, that's interesting, giving a view on some of the stocks that saw a breakdown in yesterday's trading session. Meantime, the street will also be closely eyeing in today's trading session what the outlook is on some of the companies that will come out with their numbers. Westlife, Chalet Hotels, Raymond, as we discussed, Godrej Agrovet. There's also Nazara Tech and Apollo Tyres. No Nifty 50 earnings that will be coming out today. Devin, any of the companies that I've mentioned, is there anything in particular, say a Westlife or a Raymond, Godrej Agrovet, Nazara, that you'd be watching out closely when it comes to earnings?
So, Evan, we don't have coverage on any of these companies per se, I think, at this point of time. However, would like to add few names out here. The results, I think, which came up for HFCL, Himachal Futuristic, I think they remain a little bit, I think, a promising bet at this point of time. And so is the possibility along with in Starlight Technology. These are the companies which are thriving largely on the network implementation under 5G. And I think they have suffered in past for a variety of reasons. But I guess I think the right reasons are now working for them. In case of HFCL, I think they are also getting into some of the defense items, I think, which are also basically, I think, going to be producing higher amount of revenue for the company going forward. So in my viewpoint, I think this needs probably demands a refresh attention onto them. They look relatively more promising, and given the kind of recovered results that we see, I think that should probably work for this company and the investors here after it looks like.
Okay, fair enough. That's the view coming in. And yes, indeed, when it comes to HFCL, you did see them come out with a fairly healthy set of numbers. The margins came in at about 10.8%, and even revenue growth was higher by about 21% on year. Meantime, let's just check in then as to what exactly the pre-open rates are at 9 a.m. and a little bit quiet, but yes, holding out above the 18,280 mark, at least on the Nifty and the Sensex as well. That is around the 61,645 mark in trade. Let's get in a take from you, Naresh, as to what the outlook is on, another stock that has been in the spotlight of late, and I wanted to get in a view on Alembic Pharma, given that the stock is above its 200 daily moving average, and there's also a Manappuram, that stock has seen a smart move above the 200 DMA.
So Alembic Pharma is interesting for the fact that the stock went through this whole upward cycle as well as downward cycle in the last 3 years. The stock went all the way down to the lows of 2018 to 2020. Interesting the fact that the whole pharma rally, the stock went up from 450 levels to 1100 and went all the way down to almost 450, 500 band. And now we've started reversing. So there is a good chance that the bottom is in place out here. one could look at it as a buy on dips going forward. A mean reversion trade, although may not expect very large returns, but from any dips back to 560, 550, I would expect a slow and steady move towards 660 to 700 levels. Manappuram, on the other hand, would still be a stock which would be an avoid unless one has a view on the stock given the news around it. But technically, 105 is a strong support. Would remain in this range of 105 to 120, 25 levels for quite some time to come is the view. So out here, it's a tough one to trade. And even though if you remove out the current problems, the stock has been an underperformer for the last 1.5, 2 years. So one is better off looking at Muthoot Finance in the same sector, or look at a bunch of other NBFCs which are hitting 52-week highs like M&M Finance or L&T Finance only.
Okay, let's find out those mid-cap strategies then from our chartists. And Kunal, what are you looking at today?
So I'll be suggesting a buy on rate gain. That's a stock which has done exceptionally well. In fact, was one of the positional calls which I had highlighted a couple of months back. Yesterday, the stock gave a classical breakout, a 5x to 6x jump on the volumes compared to the last 1 month of average volumes for rate gain, and that was one of the key highlights for the stock price. Would suggest a buy with 424 as a target, stop loss at 377.
Okay, rate gain it is. A thumbs up from Kunal. What about you, Naresh?
So that would be a buy on Container Corporation, continue to like the whole PSE segment one by one. This is a stock which has gone through the cycles of every time going to 550 and 750, 800. Over the last 2 years also made a bottom around 550. 550 to 600 was the price pre-COVID as well. So the stock is available at the same price as it was 3-4 years back. And now has started making a recovery. The last 3-4 months, the stock was in a range of 550 to 620. Over the last 3 sessions, we've seen a short-term breakout above the 620 mark. I would expect it to recover towards 700 levels, keeping a stop loss at 620 on this trade.
Rate gain and Concord, those are your top mid-cap ideas. Devain, before we let you go, the phenomenal rise that we've seen in railway stocks, that has clearly taken everyone's breath away. But what's your outlook given the fact that you've seen a very heady run-up and that's played out in the last 6 months to 1 month itself?
Yeah, I think most of the railway stocks are buzzing on the receipt of orders that they are having, and which is rightfully so, because I think these companies require a good amount of sustainability as far as I think their order book position is concerned and execution is concerned. So from that perspective, definitely market is justified in expecting the stock prices to recover, and they have recovered actually. However, I think important point which always remains in front of us that railway being remains extremely competitive segment on the margin front for most of the supplying companies, and that's where you don't have any chance of playing with any errors at this point of time, because I think their margin range is around 5%, 7%, and in the process, suppose if you end up hitting such kind of roadblocks like material prices going adversely against you or something, probably I think they can affect your margins, and that is what is required to be checked when you give higher amount of valuation to companies in railways. But in a normal situation, probably with the kind of growth that we are talking about in respective companies, maybe in some of the cases you justify the higher valuation, given the fact that I think they may be able to sustain the margins hereafter.
Right now, my view on railway stocks is very simple. That while government is committed to kickstart the railway capex, and if you look at the budgetary allocations for the railway sector, the budgetary allocation are the highest ever, which means the government is going to be allocating a lot of capital to railways. Railways is one sector where the ability to absorb that capex, I think, is very high. See, beyond a point, you cannot do roads because large part of the capex is already getting absorbed. But railways, both in terms of upgradation, also in terms of modernization, and also in terms of a fresh connectivity, it can really absorb that kind of an capex. What we are seeing is that there are a lot of railway capex stocks which have done rather well. Companies which historically have had a long-term relationship with railways are now enjoying the benefit of this renewed vigor in the capex cycle. But my limited point is that stock markets in the short term, first, they can always reprice the terminal value much ahead of the actual reality. So the railway business is a long capex business where the order book initially will look strong, but by the time you will execute some of these projects, it actually could take months. So my only fear is that while railway is a multi-year, multi-decade theme, multi-year theme at least, I think stock markets are pricing in a lot of good news 2 to 3 years ahead, which means that in the near term, if you bought the railway stocks with the view that this is going to be like a Jack and the Beanstalk story and it's going to continue to rise, you got to think again. Most of the railway stocks are no longer cheap. The run-up has been quite extraordinary. Weak hands have moved out, and I will not be surprised that the absolute gains what we've seen in some of the railway stocks could be behind us. We've already seen the post by RVNL turn volatile. The circuit has gone down from 10% to 5%. From 20 to 10 to 5 now. So you got to be a bit careful in buying some of the railway stocks now. Now I think there is a lot of assumptions, and there is a little bit of froth which clearly is getting built up.
Kunal, do you see that on the charts as well, given that the stocks at 52-week high are a whole bunch of them, everything from a Texmaco, if we can just go back to that plate, RVNL, IRCTC, you've got a Railtel, IRCON, they're all at 52-week highs. Is the best behind us?
So not all stocks are at 52-week high. I think IRCTC is still lagging significant behind the all-time high levels for the stock on an adjusted basis around 1100 mark. Stock is trading at 600, 650 odd zone for itself. Yes, the likes of RVNL and many other railway names, Titagarh Wagon for example, that's a stock which is trading at a significant high. So what typically happens is that you have to distinguish stocks which move up in a jiffy in a very short span of time by a margin of 40-50%. For example, what happened to RVNL, whether you look at the last 1 month of charts or whether you look at the last 3 months of charts, the momentum is quite strong on the upside. But then there are other stocks which are also lagging significantly behind. There are some stocks like Titagarh Wagon which is scaled up in a very slow and steady and a gradual manner, breaking past about that 179 mark, which was on previous all-time high levels for Titagarh Wagon, and then the stock scaled up higher to levels of 250, 300 approximately. So I believe that the momentum has to be scaled into a zone where the stocks which are into a high beta zone, you drop your position size and you be a bit more careful over there. But for the likes of IRCTC, which I still believe is a very good buy at current levels, and be the likes of Titagarh Wagon, which I think is a strong positional buy from long-term play.
Right. Okay. That's the word coming in, and a couple of these railway stocks. And yes, IRCTC, the 52-week high on the stock was 774, low being, of course, 557. Currently, it's hovering around that 628 mark. So stand corrected at that. But what's the khabar and the buzz on D Street this Tuesday morning? Heavyweight Reliance Industries has been making the buzz lately on the possible listing of its retail arm as well as the demerger of Jio Financials. What can investors expect then from the company going forward in terms of financials, capex plans, and of course the FII holdings in the stock as well? Let me take it across to Somit Sarkar, my colleague. He joins in with all the details. Somit?
Well, a lot of chatter that we are hearing on Reliance Industries. Firstly, on the business part, if you see the refining margins, which are currently at lows, are expected to recover because the street is seeing the Chinese demand is strengthening. Along with this, there is a US driving season, which is expected to be strong, while the Russian exports of refined products are also expected to be lower going forward, and all these factors would boost the Singapore gross refining margins going forward. Along with this, the petrochemical margins, now they are already up nearly 10% from the Q4 FY23 levels, but still at a discount of nearly 16% compared to their 5-year average, and this is expected to recover going forward. And the street is expecting that if the petrochemical margins come at around their 5-year averages, then that could lead to a 5% upgrade for the O2C segment of Reliance Industries going forward. And when it comes to capital expenditure, Reliance Industries historically has been a capital intensive company, and going forward, our street is expecting that the capital expenditure is expected to moderate for the consumer businesses, that is the retail and the telecom arm, while for the petrochemical and the new energy, the capital intensity is expected to still remain high. However, despite this higher capital expenditure levels, the debt level are expected to remain broadly stable because the company has also kept a target of keeping their leverage level below 1 times going forward. Now, one of the key events that the street is awaiting is the annual general meeting of Reliance Industries, which is expected to happen in June or July. And do remember, in the last AGM, Mukesh Ambani had said, replied to a shareholder's query that he would be giving more clarity on the listing of retail arm going forward. So the street is waiting for some clarity on that front, and also on the demerger of Jio Financial Service. Now, on the retail, the street is also expecting a bit more disclosure because if you see in the SOTP valuation of Reliance Industries, currently it's the retail segment which has the highest weightage. Now, Reliance Industries share prices has been underperforming the Nifty, and this is largely on the back of the FII selling. If you see the FII ownership at this moment in Reliance Industries, it stands at around 6.5 year low. So the street is still awaiting FII flows coming into Reliance Industries, because that is one of the pertinent factor for an outperformance expected from Reliance Industries going forward.
Thanks very much, Samit, for giving us all of those details there on the Khabar on D Street. A quick look as well as to what the index calls are from our charters before we move forward. It's a consensus hold actually coming in from all three of our charters on the index, given the fiery run-up that we've witnessed. And it seems like all of our charters believe that the best course of action in the moodometer today should be to hold on to your positions. Let's find out what the view is on the Nifty Bank, because yesterday it was very divided with a lot of those PSU banks coming under pressure. No trade according to Naresh, but both Kush as well as Kunal say that it's a hold call on the Nifty Bank.
Okay, the big question then is whether or not a new high for the Nifty is in sight or not. Here's Nikunj's opinion on the same.
Interesting names that we've picked out today. Mankind Pharma, the cynosure of all eyes today, and it is a well-established company as well. We are all looking forward to the listing, and all experts are saying that it is going to be at a healthy premium this time around, given the kind of grey market action. Macquarie as well said that it's well positioned to double its profit by FY26.
You got to introduce the company and say, okay, a pharma company, but it's a pharma company which gets more than 97% of its revenue from the domestic market. So it's a pharma company which gets almost its entire cash flow from the Indian market. Now that's the differentiating factor. Why is that a differentiating factor? Because if you look at any of the other Indian pharma companies, whether it is Sun Pharma, even a domestic focused company like Cipla, they don't get more than 40% of their total business actually from the domestic market. That data point will just come up on your screen. That's part one of the story. Part two of the story, if you're a domestic focused pharma company, there you go. That's the number which tells you that Mankind gets 97, and Cipla and Lupin don't even get 50. Torrent, which is a slightly higher in terms of market share, but 50% is still non-India. This, I think, is a differentiating factor. This means that there will be visibility in the numbers and cyclicality would not be there. Unlike the US generic market, in India, the drug price trends are not always very volatile. Second, the return ratios, I think, are very decent, whether you look at return on equity or cash flow generation. That means it will command a strong P multiple, which will be certainly higher than a Sun Pharma and a Lupin, which means it will be trading at the higher end of the P multiple. So then what is the comparison? I don't think it will command as a P multiple which is as strong as MNC pharma companies, but it would be a discount to that. So all right, now 30 seconds to go, and the first rates any second on your screen now. 18,000 plus, we're staying there. I think it is evident that markets for the moment are on a strong wicket. Flows, technicals, global risk off or risk on moment, all of them put together, there are clear indications that in the near term, best of the gains clearly are not behind us. So it's time to ride the momentum rather than be in a hurry to call the market. First rates any seconds on your screen now. 28 points higher for Nifty. For the Sensex, it's again an uptick of nearly 0.25%. So it's a strong start, but the market breadth, I think, is where things are looking up. The market breadth, let me put it this way, it's a ratio of about 1:5, and that's always a very formidable ratio, which means that the broader market is throbbing. The small and the mid caps stocks, in a sense, are really rediscovering a lot of momentum. Not too many newsmakers, but let's start with Zomato. Why? Because Swiggy valuations have been cut. There's a markdown for Swiggy's valuations. But Zomato stock is not seeing an impact because Zomato has already seen a markdown in terms of valuation. So this is not something new. Then let's move our attention to some of the banking stocks, and especially NBFCs actually. Bajaj Finance, Aditya Birla Finance, Indostar. The entire NBFC space now seems to be making a comeback now that interest rates have picked up. So Bajaj Finance, AB Capital, you've got L&T Finance, that Mahindra Finance, that entire space now is throbbing with a lot of action. Look at HDFC Bank and IndusInd Bank. IndusInd Bank recovered, will it sustain? HDFC Bank, is that entire MSCI overflow hang, is that behind us? Hopefully for the moment it's settling.
Yeah, it is. Just a couple of other stocks which are going to be in focus. In MGL, definitely, the Q4 EBITDA has come in over 52% on a sequential basis, and the margins as well have managed to beat the street estimates. In fact, it's a big beat. You're seeing MGL gap up right now, 5.25% higher for MGL as we speak. VIP as well has come out with good numbers. The gross margins have managed to expand about almost 460 basis points on a year-on-year basis. And then, of course, there are others like a Birlasoft as well, wherein the dollar revenue has risen about 0.5% sequentially, and the constant currency revenue has been higher, over 3%. Birlasoft, very actively traded stock, must say, 3% higher on Birlasoft as we speak. Kansai Nerolac as well came out with its numbers, a bonus issue, margin expansion of 420 basis points, 8% is the move that you're seeing on Kansai Nerolac. Of course, we've been seeing the crude sensitives as well hold out very well, and this further aids the move on Kansai Nerolac, which has gapped up 8% as we speak right now. Pidilite came out with numbers though. Those numbers are not looking all that great. The consumer durable business volumes have come in higher by 7%, but they've managed to miss the street estimates. The Q4 results are clearly below what the market was anticipating and penciling in. Pidilite down 1% as we speak right now. Aarti Industries, Kalpataru Power, all have been an earnings miss. Let's also check in on what Marico is up to and whether it's seeing a further move, whether you're still seeing a move on a Manappuram or for that matter on an IndusInd Bank as well. Those stocks will just come up here on the screens. Marico sees some bit of buoyancy more, Manappuram rebounds further, and IndusInd holds out by 0.8%. What are the HDFC twins doing? Yesterday, of course, they saw a marked recovery, and today it's a much more tempered move, flattish at that, marginally higher. For the index as well, it's fairly tempered, but the headline number is not going to give you any reason to complain. We're marginally higher, but Kunal, on the spot now, we've made it to 18,300.
Yeah, I think it's a good comeback for the index because what the SGX was actually showing a muted start, but then if it's on the positive side, it just adds to a more positive booster for individual stocks. The stock I would, which I would look to trade in the open would be Glenmark Pharma. Looks very attractive as a setup, trading at 570, which is already a fresh swing high for Glenmark on the short-term charts. Looks very attractive on the short-term time scale.
Glenmark Pharma, that's what Kunal is picking out. Just taking a look at the screen there, Naresh, the fact that we're holding out comfortably in the green around the 18,300 mark, where are you sensing opportunity?
Considered like Axis Bank, that is a stock which can take leadership in the banking space going forward. So expecting that to be a leader. So still an accumulated current levels and more on the way up at 19.